All right, I'm going to get started here. I appreciate everybody who has joined thus far. I am Garet Strange with Hobbs Group Advisors. We are a financial planning and wealth management firm in Columbia, South Carolina. Retirement planning is one of our core competencies as a firm. It's something we talk a lot about with our clients. And today I'm going to share with you some things you should be thinking about as you approach retirement and some key considerations in retirement planning. Retirement planning is really all about creating a good life for yourself after you leave your primary job. It doesn't necessarily mean you won't work. In fact, many people plan to continue working in some capacity in retirement. But the work you do in retirement shouldn't feel like work. You'll be working because you want to, not because you necessarily have to. So if you're here, it means you're probably thinking ahead to retirement and wondering about things like, have you saved enough to retire comfortably? And how much income can you expect to produce from your savings and investments in retirement? What is the best way to utilize those savings and investments to generate income in retirement? And what are some things that maybe you're not thinking about, but should be as it relates to retirement? So over the next 30 minutes or so, I'll discuss some of the basics of building a retirement plan. And for the sake of time, if you have questions during the presentation, please utilize the chat feature and type those into the chat box. I will address those at the end of the presentation. And questions are encouraged. So if there's ever a time to plan, retirement is it. Once you leave your job and start depending on all the other sources of income in retirement, you want to be sure that that income is sustainable. Nobody wants to go back to work at 80 because they didn't plan right. So it's really important to have a plan. And a good retirement plan addresses things like how much income you'll need, where that income will come from, when you will start Social Security, whether you plan to work or not, taxes, and how to best manage your investments and subsequent withdrawals from your retirement and investment accounts in order to create a sustainable stream of income that should last throughout your retirement. Above all, we want to make sure that you don't outlive your assets. So we need a plan to manage your retirement savings over roughly a 30-year time period, but perhaps more. The first thing we do with our clients is we help them take a step back and imagine how they want to live their life in retirement. We ask them what are their goals, what are their needs, their wants, and their wishes. So, what expenses do they have that they have to cover? What do they want to do? And if they could have, their best wishes, what would that look like? Where will they live? What will they do? How long do they think they'll live? What surprises could life potentially hold? So we help them, answer those questions and figure out how much income they will need to live the life that they would like to in retirement. So for some pre-retirees, the first consideration is where they will live. Not everybody changes their residence in retirement, but a lot of people do. Once you're not tied to a job, you obviously are free to live anywhere. So perhaps you'd like to live closer to your children and grandchildren or friends. Maybe you'd like to downsize. So affordability could be a key driver of the decision making as to where you'll live. And then there's, general preferences such as, the weather, the culture, recreational opportunities, and access to excellent healthcare and hospitals. Now, where you end up living will have a pretty large impact on your retirement budget. So this is one of the first questions you'll want to consider. Along those same lines is, how much home will you need? Most Americans' net worth is tied up in their home equity, and home equity is generally non-income producing and illiquid. You can unlock some of that home equity with financial instruments such as reverse mortgages, but they can also be complicated and hamstring your flexibility later in life. Making the decisions to downsize or even potentially rent may unlock a substantial portion of your net worth to help support your standard of living in retirement. If you continue to own, you should consider right sizing your home, which may mean potentially downsizing to a home that may be more appropriate for aging and less costly to maintain. But if you're not working anymore, how are you going to fill your time? From a financial perspective, your daily activities really fall into one of two categories. You're either doing income generating activities or you're doing expense generating activities. If you plan to work or run a business in retirement, you'll be generating income from your daily activities. On the other hand, if you're not working, you'll need to fill your time doing something. Unless you plan to take walks and read library books all day, you're probably going to end up spending money on things like travel, hobbies, and entertainment, which is, there's nothing wrong with that. That's what retirement should be about, but you'll just have to factor those into your budget whenever you're coming up with a retirement budget. An industry rule of thumb is to expect to spend anywhere between 70 to 80% as much per year in retirement as you did while you were working. And the more free time you have, the more you can expect to spend. You want to travel, obviously vacations and long weekend getaways cost money. What you plan to do in retirement plays a large role in determining how much income you'll need. A large consideration in retirement planning is how long you think you'll live. That basically determines how long you need your money to last. It's best to plan for the worst case scenario, which in that case is assuming you'll live to 95 or 100 or beyond. The average life expectancy in North America is 81, but for a female, if you made it to age 85, there is a 53% chance you will live to 85 and a 32% chance you will live to 90. For a couple, there's a 72% chance one of the spouses will live to age 85 and a 45% chance one of the spouses will live to 90. Of course, if you die before then, it means you probably left some money on the table and you could have lived it up a little more. But what if you don't? You'd rather have money left at the end of your life than life left at the end of your money. So don't rely on the average life expectancy for your retirement income plan. Unexpected events that are not carefully planned for can derail a very good retirement plan. But part of retirement planning is taking a look at your life and the world around you and consider the unexpected. The biggest surprise for most retirees are healthcare expenses. If you have Medicare and a supplemental policy, many of your healthcare expenses are covered, except for premiums and some co-payments. But the biggest concern is long-term care. And ironically, it's the healthiest people who are most likely to need long-term care. If you live long enough, it's pretty likely that the issues that come along with natural aging can prohibit you from performing activities of daily living. So you'll need some kind of nursing care in your old age. According to a recent study by Fidelity Investments, a retiring couple can expect that through the course of their retirement, they will incur expenses of $250,000 for healthcare. Surprises can also come from family members, whether it's caring for aging parents or children needing to move back in the home. You may need to be prepared for unexpected expenditures of time and or money. Economic shocks and subsequent stock market fluctuations could cause your investment portfolio to decline in value. And there is truth to the theory that market declines hurt much more than gains help, especially when you're withdrawing from your portfolio. In addition, interest rate changes could decrease the value of your bonds, and inflation is always a big threat to retirees. Economic forces cannot be predicted in advance. That's why it's important to have an appropriate investment strategy and a retirement plan that has been stress tested against adverse economic events. So how much income will you need in retirement? As I mentioned before, there's really a lazy answer and there's a right answer. The lazy answer is you need about 70 to 80% of your current living expenses. But the right answer is, the most accurate way is to estimate your income needs by utilizing a retirement budget. And a lot of the questions that we consider early on in the planning process, this is where those answers come into play. You know, if you know where you'll be living and whether or not your mortgage will be paid off, you can more accurately estimate your housing costs. And you really want to do that for all categories that you anticipate spending money on in retirement, such as, you know, travel, food, entertainment, utilities. Those are a lot of the big ones. You know, once you have an idea of how much you will spend in your retirement years, it's time to figure out how you're going to pay for it all. So, you know, next we want to identify all the potential sources of income in retirement. One important source for many people is Social Security. If you and your spouse are eligible for Social Security, you need to consider how to claim Social Security to help maximize your expected benefits. Excuse me. Another increasingly less common retirement income source is pensions. If you're fortunate enough to have a pension, you may have to make some elections, like whether or not there will be spousal or survivor benefits for your heirs in the event of your passing. If you have an annuity, perhaps it has a living benefit that guarantees may be able to provide you income or guaranteed withdrawals for life. Perhaps you'll work part-time in retirement, or, you know, perhaps you have investment property or interest in a business that will continue to generate income after your retirement. What's so different about retirement compared to when you're working is that you have to manage all these income sources. You can't count on a direct deposit of a paycheck anymore, so you have to coordinate these income sources. And each of these income sources has different characteristics, so it's important to keep those in mind. Some of the characteristics of these retirement income sources: Social Security. You know, Social Security is powerful. It keeps up with inflation and is guaranteed for life. You know, once it starts, you don't have to think about it very much, but deciding when to start is a huge decision. Pension income also is guaranteed for life, but pensions generally are not adjusted for inflation. Maybe you plan to work some during retirement, you know, depending on what work you'll be doing, or if you own your own business, your income could either be fixed or variable. But it's important to keep in mind that that income will not last forever. You know, at some point you'll stop working for good. And then there's investment income. This includes the withdrawals that you take from your investment accounts, retirement accounts, savings accounts, you know, et cetera, which is the trickiest part of retirement income planning. You know, that income can be fixed or variable. It's taxed at different ways, and you got to actively manage it to make sure it can last throughout your retirement. So in looking at your retirement income, most people start with Social Security because it's a predefined amount of income. You know, it's important to gather your most recent Social Security statement for you and your spouse to see what your benefits are projected to be. It's one of the most powerful sources of retirement income because you can't outlive it, and it adjusts for inflation. You can begin drawing Social Security at 62. That would be at a reduced benefit. You can take your full benefit at what's called full retirement age, and you can delay drawing Social Security until 70. For every year that you wait to draw Social Security, you get about an 8% increase on your benefit, plus the cost of living adjustments that are also applied to Social Security benefits on an annual basis. Another potential source of income is a pension. You know, you should, if you're eligible for a pension, you should find out when you can begin drawing it, how much the benefit will be, and what your distribution options are. You know, sometimes it's best to take it as a series of payments over your life expectancy, but other times it's better to take it as a lump sum and roll it into an IRA so you can manage the investments and the withdrawals. You often have options such as a lump sum payment, a single life annuity, a joint life annuity, a partial survivor benefit, or a period certain. Your selection is generally irrevocable when made, so it is important to truly review all your options. For example, while selecting a single life annuity may provide the highest benefit, it will not provide income to your spouse or beneficiaries once you pass away. So how about work? More and more people are planning to work some during retirement. If you plan to keep working at your present job, you aren't really retiring, you're just delaying retirement. And that is a very good decision for many people. A few more years of work now will add to your financial security, boost your savings, and shorten your drawdown period. Another potential income source in retirement that we've briefly discussed is an annuity. It's similar to a pension in that it can provide guaranteed income for life, but it is funded by you with investment dollars rather than, an employer. Annuities are generally misunderstood and missold, and they are complicated, can be expensive, and there are often penalties or withdrawal charges associated with annuities. So once you get into an annuity, a lot of the times you're stuck. So if you're considering an annuity as part of your retirement plan, my best advice is to consult with, an objective financial planner or objective financial advisor to evaluate the potential benefits and cost of an annuity as it relates to your specific retirement plan. Annuities in and of themselves are not bad or good. There really depends on the annuity, depends on the person, depends on the situation. So through your life, you acquire a lot of different accounts that you stuff with money for a litany of reasons, like retirement accounts such as IRAs, Roth IRAs, and 401ks, non-retirement accounts like brokerage accounts, checking accounts, savings accounts, CDs. All of these accounts are important because they represent savings that will eventually fund your retirement. And finally, some retirees earn income from other sources, such as investment in income producing property, interest in a business that will continue producing income after you retire. Often this type of income is variable, but it does need to be considered along with your other sources. Now, once you've identified all the sources of your potential retirement income, you can tap into retirement. It's time to figure out how do you create an income stream from all your sources. You have to start integrating all your different savings, investment, and retirement accounts, into your retirement plan and figuring out how to spend those assets and what's the best way to spend those assets so that your assets last as long as possible. There are a number of ways and theories about how to draw down your assets in retirement. The classic approach is to live off the interest. Another formula that you've probably heard of is the 4% rule. A third, and one that I prefer, is the bucket approach. And the fourth is to invest to meet your different type of expenses. So using, fixed income to pay for mandatory expenses and using more variable income to pay for discretionary expenses. There are more withdrawal strategies than these and a lot of derivations that come with these, but these give you an idea of what you need to consider in funding your retirement. For example, suppose you want to retire in your 60s, but you don't want to claim Social Security until 70 to get the biggest benefit. That's great, but how are you going to fund that gap? And how are you going to pay for your expenses in retirement without the benefit of Social Security? Which account should you withdraw from first? At all times, the goal is to optimize your situation so your money lasts as long as it possibly can. We're going to review these four approaches in a little bit greater detail. The living off the interest is a classic approach to retirement income. You invest in income generating investments like bonds and dividend paying stocks, and you spend only the income generated by the investments, leaving the principal alone. A common misconception is that once you dip into the principal, you're doomed to run out of money. That's kind of an old school way of thinking. In any case, today's low interest environment makes this strategy basically irrelevant unless you have a large enough portfolio. With interest rates so low, $1 million portfolio may only earn between $20,000 and $30,000 in income without having to take on additional risks. So this approach is somewhat irrelevant. 4% rule received a lot of attention because it's so quick and easy to understand, but simply put, the first year you retire, you take 4% out of your retirement investment accounts. It doesn't matter how much your investments earn that year. If you start with $1 million, your first withdrawal is $40,000. This could come from principal, interest, dividends, or market gains. The next year, you increase that amount by the rate of inflation. So if inflation is 3%, for example, your next withdrawal is $41,200. Again, it doesn't matter how much the portfolio earns. On the day you retire, you set your withdrawal amount and increase it each year by the rate of inflation. This idea came from a study that was done in the 90s that reviewed every 30-year time period going back to 1926 and determined that if 50% of your assets were invested in stocks and 50% in bonds, the 4% withdrawal rate had a 0% chance of failure or running out of money. So it has become somewhat of a standard for retirement income planning. However, it does have critics. Some people say that it doesn't let you spend enough. If markets do very well, you're not allowed to take out more, so you end up leaving a lot to your children. Other critics say that going forwards, markets might not do as well, so that the return assumptions, may not be accurate. The approach that we use is kind of a hybrid approach of this with slight variations, but this is the approach that we are biggest believers in. And basically with a bucket approach, you're earmarking different accounts or different assets for various needs and invest each one separately. The most popular way to do this is to arrange your buckets by time horizon. So any money that you'll need within the first 3 years is placed in the first bucket and invested very conservatively. So there's no worry that your investments will decrease in value at the time you need the money. So you basically figure out how much money you'll need over the next 3 years to meet living expenses and put that amount in the first bucket. Amounts over that are placed in another bucket. And because this bucket has a longer time horizon, you can invest them more aggressively for growth and inflation protection. As you draw down the assets from the first bucket, you replenish them with withdrawals from the second bucket. So you always have 3 years worth of expenses in the first bucket. Maintaining 3 years of expenses in a more liquid and conservatively invested short-term bucket will also help you not panic when markets decline, because you've got at least 3 years of withdrawals set aside to where you're not at risk of having to, reduce your withdrawals or have to sell anything in the growth bucket while assets are down. Another formula is covering your fixed expenses with things like, annuities. I'm not going to spend a whole lot of time on this. This is a strategy that is not used very often. So here's some of the pros and cons of each one of these strategies. The live off the interest. It's very simple, but it's you should only expect a small amount of income. There's no inflation protection. The bucket strategy, which we're the most familiar and biggest proponents of, it's got flexibility. There's inflation protection. You can have potentially more income when markets are good. However, there are some complexity involved. It's harder to set up. It requires a good bit of monitoring, and the success does depend on the investment results. So you have to manage the investments appropriately as well. So taxes are an important element in your retirement income plan. We're not going to get into a great deal about taxes today, but there are some basics to know. Different types of income are treated differently when it comes to taxes. And the goal of retirement planning and retirement income planning is to minimize the amount of taxes you pay over your total retirement period. So this may mean accelerating or paying more tax in a given year to save on taxes in a later year. So Social Security benefits are tax-free unless you have other income and your other income is over a certain amount. In that case, up to 85% of your Social Security benefits may have to be reported as income. And notice I didn't say your Social Security is taxed at an 85% rate. It's just that 85% of your Social Security benefit could be subject to tax. Pensions are generally taxable. Income from work is taxable. One thing to keep in mind about income from work is that the government never takes 100% of your money, so it always pays to work, even if you lose some of your income to taxes. So not working is not a good strategy for boosting your retirement income if you're able and willing to work. However, you could consider postponing your Social Security or reducing your retirement plan withdrawals and saving these resources for later while you're working. Sometimes it's best to take just as much income as you need and keep the rest protected from taxes. Investment income can be taxed in different ways depending on the type of the account. If they're invested in a taxable account, you pay tax on investment income as it is earned, not when it is taken out for spending. In other words, taxation of taxable investment account hinges on investment earnings, not your withdrawals. Conversely, if your money is in a tax deferred account, such as an IRA or 401k, the investment income is not taxed when it is earned. Rather, you pay taxes on the distributions at your ordinary income tax rate when it is withdrawn. Withdrawals from Roth IRAs are tax-free, provided you have had the Roth for 5 years and are over age 59 and a half. So what can you do to lower your taxes in retirement? Some things to think about include drawing down your IRAs before age 72 in order to reduce the required minimum distributions the government forces you to take out once you turn 72. If you think about it, once you turn 72, you're going to have Social Security and required minimum distribution. So you've got two spigots of income that you really can't turn off. That could force you, theoretically into a higher tax bracket. Another thing we talk to our clients about is converting traditional IRAs to Roth. You have to pay tax on the money you move to a Roth, but once your money is in the Roth, you can withdraw at any time without paying taxes. And, delaying the start of your Social Security benefits until age 70 not only gets you a higher benefit, but it also reduces the number of years you will need to pay taxes on benefits and gives you opportunity to live off your IRA, thereby withdrawing down those balances and or doing Roth conversions. So basic tenet of tax planning generally is deferring taxes and paying taxes off as long as possible. For many people, the idea of tax deferral is so appealing that when it comes time to start spending their retirement income, they draw from taxable accounts first to keep tax deferred accounts growing for as long as possible. That may be appropriate for some, but not for everybody. Decide which accounts to tap first. Consider not just the account itself, whether it's taxable, tax deferred, or tax free, but also the particular investments within each account. These investments in turn relate to your risk tolerance, time horizon, and income needs. The downside of tax deferral is that it can't go on forever. You've got to start taking required minimum distributions at 72, and the larger your account, the larger the distributions will be and the subsequent tax. If the account is very large, the required distribution could throw you into a higher tax bracket, force you to pay more tax than if you drawn the account earlier and paid some of the tax sooner at a lower rate. But there's no magic formula for tax efficiently managing your retirement income. You have to take into account your spending needs, tax situation, risk tolerance, life expectancy, and estate planning requirements. It is a very nuanced planning situation that is uniquely designed, or should be, just for you and your situation. So a case study here, I'm going to actually skip over this case study because we're running out of time. I can provide you a case study if you follow up with me via an email. I'm happy to provide a case study for you and what a retirement income plan looks like. One important thing that we help clients do as it relates to retirement income planning is figuring out trade-offs. So if their plan doesn't necessarily work the exact way that they would like it to, we figure out how to help them weigh trade-offs of things they could sacrifice and what is more important than other things to them. It's really the steps to getting a retirement income plan together is you want to gather all your necessary financial information, your investment statements, your bank statements, your credit card statements to help you draw up your budget, your Social Security statements, and make a list of your questions and concerns as they relate to your retirement planning. You want to you pull out your latest tax return that contains a wealth of information that can help with retirement planning. You also want to gather all your insurance policies together to help determine if you have the right protection or enough protection. And finally, you want to pull your estate planning documents together, your will, your trust document, if you have one, your advance directive for healthcare. Make a list of your questions and concerns. I'm sure that hopefully there were some questions that came up for you during the seminar. You want to write those down and focus on, some of those questions and concerns in the coming days, weeks, and months. So our core services at Hobbs Group Advisors are financial planning and wealth management. As I said, we devise comprehensive retirement plans for people all the time, and they go off on their own, go off and execute it on their own, and come back, periodically to us for a review or reevaluation as they see fit. Our premier and most comprehensive service is wealth management, where we manage people's assets and investments and provide proactive real-time retirement planning alongside the asset management. We take a more hands-on approach with the wealth management and execute much of the retirement plan for the client. We also are providing, proactive advice as it relates to the retirement plan, and helping our clients, adapt to the ever-changing situations that life presents. So that's all I have for today. I hope this was helpful. I hope that you all got something out of this, or if nothing else, it at least piqued your interest, so that you may know what questions you need to be asking or things you need to be doing to prepare for retirement. Hopefully there are some some considerations that you saw that you haven't thought of. I know this was a lot of information, and it was meant to be kind of a high level overview of all the different aspects of retirement planning. We plan to do some more of these webinars in the future that dive down more specifically into a lot of these topics. A lot of these topics can warrant webinars on their own. Social Security claiming strategies, Roth conversions, withdrawal strategies in retirement, investment management in retirement, benefit pros and cons of annuities. There's tons of things that we could do webinars on in and of themselves as it relates to this presentation. So I hope this was helpful. I appreciate all of you who attended. There will be a recording of this webinar available. If you would like one, we can send that out to everybody. I am going to see if I'm going to just pause for a second, see if anybody has any questions. I don't see any questions right now, which is okay. And you also are free to email us with any questions that you have after this webinar. I mean, if you do have a question right now, I think it would be good for you to ask it, because if you have that question, it's likely that somebody else probably has that same question. So don't be bashful about asking questions. So I will give everybody a little bit of time to type any questions they may have in the chat box. And if I don't have any questions in the next, just call it 3 or 4 minutes, then I will sign off. But I do appreciate everybody's attendance. And I look forward to seeing you all on a future webinar. Oh, also the recording will be on our website, and it will also go out via email. So be on the lookout for that if you were late or wanted to revisit something that I talked about. But our recording will be posted on our website under the blog tab. Thank you, Francesca Passon from my office, for alerting me of that. She keeps this place together. So one question I do have here, I have gotten a question is someone is asked. Well, I have two questions here. I have one question is when is the appropriate time to reevaluate the annuities I already have? And the appropriate time to do that is as soon as possible, especially if you're approaching retirement. You want to, it's better to evaluate those and be able to make those changes before retirement than it is during retirement. So as soon as possible is the right answer to that. I have another comment from a participant that asks to comment on the effect of inflation in retirement, and that's a loaded question. Obviously, the effect inflation has on retirement planning. Assumptions have to be altered in retirement planning to make sure that your sources of income and investment returns factor in the current rate of inflation. We're obviously in a very high inflation environment currently. So the effect inflation really has is you have to really identify those sources of income and figure out what impact inflation will have on those sources of income. Obviously, as we talked about, Social Security is adjusted for inflation, so that should rise with inflation. Pensions typically do not rise with inflation. Investments should over the long run be positively impacted by inflation, as the companies that you invest in participate in the inflation of goods, so they're raising prices. They're able to generate more income because prices are going up. Bonds are negatively impacted by inflation because bonds pay a fixed rate of return or a fixed coupon payment. So that coupon payment doesn't spend as much or doesn't go as far as it once did as the prices of goods go up. So I see a lot of retirees who have investment portfolios that are too heavily invested in bonds, and bonds do not hedge well against inflation. So it's important to have an investment strategy that accounts for the risk of inflation. We could do a whole webinar on the effects of inflation on retirement income planning. So I've got to take this final question here. What are some of the best charitable giving strategies for today's tax laws? So that's a great question. Two of the most common charitable giving strategies that we utilize for a lot of our clients are qualified charitable distributions and donor advised funds. Qualified charitable distributions you are allowed to donate money to a charity directly from your IRA and not pay any tax on that IRA withdrawal, provided that it goes directly to a charity, and you're able to do that at 70 and a half. So the benefit there is that you can use your IRA to give money to charity, not pay any tax on that distribution from the IRA. That thereby lowers your IRA balance, which should lead to lower required minimum distributions in the future. The other strategy I talked about is a donor advised fund. What a donor advised fund allows you to do is make a large lump sum contribution to an account where you are able to realize the tax benefit, the tax deduction for that lump sum contribution to the donor advised fund in the year in which you make the contribution to the donor advised fund. You can then distribute it to different charities as you see fit, in a time frame that you see fit. You just get the tax deduction up front. That is generally useful because most people who contribute to charities, would get a deduction on their tax return for what they contribute to the charity. But because the standard deduction is so high now, it takes a relatively large charitable contribution to put you into the realm of where you itemize your deductions. And if you don't itemize your deductions, you're not getting tax benefit for that charitable contribution. So by utilizing a donor advised fund, it allows you to front load charitable contributions so that you can have a large enough contribution to be able to itemize and use that deduction on your tax return. All right, everybody, I appreciate all your time. I appreciate everybody that stayed on to listen to the answers to these questions. I do appreciate the questions as well. If you have any questions following this webinar, feel free to email us, feel free to call us. We are happy to help however we can. I hope you all have a great rest of your Wednesday and look forward to seeing you on a future webinar in the future.